Good afternoon. Welcome. I'm Josh Schimmels, publisher and CEO of the Los Angeles Business Journal. It's great to be here hosting another real estate strategies panel discussion. Back in June, we hosted part one of our real estate series where we focused on workspace trends. We're shifting topics today to talk about the ever-changing and quite active industrial market here in greater Los Angeles. Really, the amount of activity is almost at Mount Everest proportions these days. Today, we have the opportunity to hear from and engage with some of the region's most knowledgeable experts in the field. It's a real privilege to have them all here. I've enjoyed getting to know them over the past couple of months. And I can tell you that you're in for a great conversation with a really fun group. We're going to cover a range of topics, including the state of local industrial market, the impact that surges in e-commerce this year have had on the sector, and industrial development and redevelopment trends, and also alternative industrial solutions. Additionally, Prologis just published part one of their automation special report. So if you'd like to receive a link to this, please send us an email to events@labusinessjournal.com. Again, that's events@labusinessjournal.com. Throughout the discussion, we'll be conducting live poll questions. So when you see them pop up on your screen, we encourage you to take a moment and respond, and then afterward, we'll compile and publish the results on our website for you. We did receive several audience questions ahead of time in the registration process and have done our best to incorporate many of them into our program. So many thanks to those who already participated. That said, if you do have other questions for the panel, feel free to add them using the Q&A box here on Zoom. And if we have time towards the end, we'll try to have the panel address them. In just a moment, I'm going to introduce our panelists and our moderator, and we're going to get right into it. I want to thank our two host sponsors for helping to create and engage our readers with all of this great information. Many thanks to our friends at Newmark and Prologis. We truly value your partnership, and it's a pleasure to be here sharing this virtual stage with you. So thank you both so much. All right, now I'd like to introduce each of our esteemed panelists. You can also read more about them by visiting our site at the link that's going to be provided throughout the program here on the screen. So first, we have John DeGrinis. He's the Executive Managing Director, Newmark. Next, Adam Deierling, Managing Partner, West Harbor Capital. John McMillan, Vice Chairman, Newmark. Lisa Reddy, Vice President, Prologis. And lastly, today's moderator, Rob Antrobius, Senior Vice President, Market Officer with Prologis. Rob, thank you so much for being a part of this today and for being here.
Yeah, thanks, Josh, and thanks to the LA Business Journal. I think everyone on this call would hopefully agree, or I trust does agree. LABJ is a great resource for news, not only about real estate, but other business ventures in LA. So we appreciate you creating this forum for us. And I also appreciate all the panelists you see joining us. Industrial is busy now, and so thanks for taking time out of your busy days. For industrial, it's obvious e-commerce is a huge driver. If you think about these panels, just a few short years ago, many of the panels were guessing and trying to forecast what was e-commerce going to become, what trends was e-commerce going to bring to us. And it's kind of unfortunate, obviously, with COVID, that a lot of that was accelerated. And so a great thing about this panel today is they are right in the middle of e-commerce transactions as we speak. They've closed a number of e-commerce type transactions. So instead of guessing and wondering what the trends are, I hope you all find it interesting today from the standpoint, we're going to get some real-time feedback on industrial trends as it pertains to e-commerce and beyond. So with that, we'll jump in right away. Adam, you and your firm, West Harbor Capital, you just came off a very successful land acquisition and a value add type play, and it came full circle, and you did sell the asset very recently. So congratulations to you on that. Could you touch upon that and talk about how you dealt with the municipalities, the e-commerce demand that was in play with the customer that leased it, et cetera? We'd love to hear more about that.
Sure. Thanks, Rob, and afternoon, everybody out in Zoom world. As an investment and development firm focused here exclusively in Southern California, all of the value add deals we pursue come with plenty of hair on them, whether we like it or not. And this one was definitely no different. It was an 11-acre site we bought in Orange County. We closed March of 2019 with the vision of executing a horizontal development to create a last mile facility for the e-commerce space. So the site, when we were introduced to it, it actually had been in escrow previously with 3 different developers. All of them passed on it, and the most glaring reason why they passed had to do with the entitlement in the local municipality. The local municipality saw this site as a junkyard, and believe it or not, wanted to keep it a junkyard for the foreseeable future. So we came into the deal with that in mind. And so in order to get through that, and what we do here in the wonderful world of development, which Rob and Lisa can attest to, is you've got to befriend the municipality and explain the vision you have on these infill assets, especially like an 11-acre site here in Orange County. So the first part of that, we had to there were 31 tenants on the site. So cities hate losing businesses. We had to vacate all 31 tenants in order to get to the plan we were trying to execute on. So we did that successfully after about 4 months of closing. During that time period, we started conversations with the city. The city didn't like the concept of a last mile facility. A lot of these municipalities think last mile, oh, this is 553-foot trucks that are going to be, banging all over our streets. It's not going to create many jobs. The actual facility is going to get very beat up. It's an old vision of industrial real estate. And what's happening now, we started sitting down from a staff level all the way up to the elected officials and tried to change their perspective on what's really happening in this last mile, horizontal development e-commerce space. And what that entails is, it's the vehicles being brought onto this site and running through the city streets. They're really personal vehicles in those vans that we all see come to our doorsteps. So there is some traffic, but it's minimal. So that's the first thing you have to sit down with these municipalities and explain to them. The second is that there's actually very good paying jobs that come with these last mile facilities. Cities love having jobs in their municipality. And so, we told them this facility would likely bring somewhere between 100 and 200 jobs to the city, which, obviously piqued their attention. And then the last thing was, the last mile users require very sophisticated facilities. So this junkyard that literally had everything from a guy raising chickens to a classic car restoration company, we convinced them that we were going to turn it into a Class A facility and hoped to get one of the larger companies in the space to lease it. Fortunately, we did. We secured a lease with a Fortune 50 company that has perfected the movement of parcels in our market. And they don't drive brown trucks, but I'm not at liberty to speak as who they are under some confidentiality reasons. But they leased the site. They were looking for a facility within the Orange County market that they could get to the last mile users' doorsteps and businesses. They'd been searching for almost 2 years for a facility like this. So timing lined up very well. We presented all this to the city. They got on board with our program. They were very excited about the potential outcome of this site and gave us a green light to go. So we completed that development in the third quarter of this year. The tenant took occupancy, started operating. At that point, we realized we'd unlocked all the value on this site. So we took it to market and we received over 10 offers on the site from institutional buyers. The logicals, some of which are actually on this call. We ended up executing and sold the asset just north of a 4.5 cap. So the city was ecstatic. The reason we got to success on this asset had a tremendous amount to do with the fact that the city ultimately came on board with us and saw that this use was a huge benefit to the city because those people that sit at City Hall also take packages to their doorsteps every day like we all do.
Yeah, thanks for that. Well, congratulations on that, Adam. That was a great and textbook case study of executing on that. So kudos to you and West Harbor Capital on that. And thanks for sharing the details. You'll notice on today's call, many of us, for those of you who have dealt with any of the larger e-commerce or delivery, companies. You'll notice we'll probably have to dance a little today. We're not allowed to use names, as many of you know when you deal with certain big entities, but regardless, you'll probably figure some of it out. Another item that we've read about and seen talked about is the conversion of retail to industrial. I think a lot of us can attest to the fact it's a lot easier said than done. Many cities don't want to see that conversion, even though that person at the city is probably opening their Amazon package while they're telling you no, they don't want to see redevelopment. But regardless, it is happening. And John M., I know you and your team were a part of a large one in the South Bay, a true conversion deal. Can you tell us a little bit about that?
Yeah, absolutely, Rob. Appreciate that. And I can mention it because it did make its way into the press. There were people monitoring what was happening in the city of Torrance, and it was with Amazon. So we identified an old Costco that's on Sky Park that Costco had vacated. They bought the property to the north of them and built a much more modern Costco that had the gas station and a car wash and more land. So they had a 1970s era 147,000 square foot building that had been on the market for lease, hunting for another retail tenant for over 3 years. And we approached the ownership a couple of times over the course of about 18 months. And then we were able to identify a developer who had a very good rapport with the city of Torrance, who met with the city and said, look, we think this makes a lot more sense as an industrial site than as retail. And the area that it's located in, a lot of people are looking at this trend now of converting retail to industrial. And it's really critical that you have wide streets. You're not immediately adjacent to residential. You're not going to impact the neighborhood. And so this particular building, where it was situated, really worked out really well. So we started entitling the site for 3 industrial buildings. We were in escrow for over a year. There was quite a bit to get through with rezoning and whatnot. And as soon as we closed, we were still moving forward with the entitlement process. And the developer and our team agreed that we should just take a flyer and put this in front of Amazon to see if this might be a good last mile facility. We put it in front of them. They literally flew down 2 days later to tour it. And at the tour, they told us, don't touch anything. We'll take the building as is and go from there. So it's really a critical facility for servicing the Palos Verdes Peninsula. And they're going to tear down a portion of it. And it'll be 130,000 square feet on 14 acres. But what's really interesting, and credit to Torrance, that they recognized, as Adam said, initially it's difficult to get past the fact that you're not going to get that sales tax revenue. But Amazon met with them a number of times. They promoted the jobs that would be at the facility. It's going to be in the neighborhood of 1,200 jobs. At holiday peak periods, it could get to be 1,500 jobs. And theoretically, you would imagine that a lot of people coming and going are going to stop at Starbucks. They're going to gas up their cars. They're going to get lunch. They might get their groceries. So there will be some incremental sales tax bump there as well. And also to Adam's point, it's not full-size trailers. They may get some deliveries in a couple times a week, but the facility is primarily going to be manned by the Amazon vans and personal vehicles. So it was not a intense amount of 18-wheeler, full-size trailer truck traffic to the area. So since we've done that deal, we've been approached by people that own movie theaters and all sorts of retail properties, wondering if they could be industrial. There's a lot of other factors that went into this deal other than just the proximity to the people. So I do think it's a growing trend, but it's going to be a very selective, location-driven decision-making process by these e-commerce companies.
Great. Well, congratulations on that deal, and thanks for that, John. We appreciate the fact you could share a lot of names on that one to even bring more color to it. Lisa, Prologis, and in a couple cases, the team led by you executed on a couple of these type of conversion deals, both in LA and one recently in Orange County on the freeway. What can you share with us about those?
Yeah, hi Rob and hi everyone. I mean, without getting into specifics, one trend that we've been seeing is that one size really does not fit all for all of these e-com uses. I mean, over the past 12 months, we've seen each group, each user have their own respective needs for layout, parking count, etc. And even within the greater corporate umbrella of these customers, each department has their own needs. So what might work for one department within the same company doesn't work for the same for the other. So it's been very interesting. Some commonality that we've seen though from the e-com users is they are continuing to focus on locations with close proximity to the rooftops, good freeway access, low coverage sites. I mean, as John just mentioned, you know, the amount of jobs that these fulfillment centers bring with them is huge. So the parking need for employees, and then also their you know, vehicles for deliveries is huge. And also if there's a need for off-site parking, there's a real focus on finding sites that are close to their current fulfillment centers. So, you know, that then even narrows the scope even more. And obviously emerging from COVID, we expect that a lot of users of logistics real estate are going to start building their inventory levels higher to ensure resiliency in their supply chain. So we do think that this is going to have an impact on the retooling of the supply chains for the increased e-fulfillment users. And again, we don't expect there's going to be a cookie cutter approach. It's going to vary by user and by department within that user.
Thanks, Lisa, for that insight. And on this first round of questioning, you know, we've got Mr. John DeGrinis, the borderline legend from the North LA market. John, it's great to see you, and thanks for joining us here. The North Los Angeles market, where you specialize in and beyond, they're definitely along for the ride also when it comes to all these positive trends of industrial real estate. Could you talk about what are the drivers up there in North Los Angeles, if they're different at all? Has e-commerce been a part of your overall market activity, and what other industries might you see growing out there? And John, why don't we start with pushing the mute button?
Yeah, there's technology for you. Can you hear me now, Rob?
We can hear you now, yeah.
So, you know, the Valley is a market that is almost like a redhead stepchild to some of you developer types. But one of the things that a lot of people don't realize is that it's the 5th largest city in the United States if it wasn't part of the city of Los Angeles. So 2 million or so people live out here. So distributing to these folks is a major driver in and of itself. But going back in history, historically, it was all manufacturing. The Valley is one of the concentrations of manufacturing of our entire country. Our industrial base out here is about 250 million square feet. So it's about a quarter of the whole Metro LA base. You know, a lot of people ask, well, why the Valley? So as I mentioned, the Valley began in World War II, starting out at the Burbank Airport. And, you know, everything to the west of it was basically citrus orchards. They grew from east to west. It's got a really diversified labor base. It's got skilled to unskilled labor. It's got diversified housing that can accommodate everybody in your facility, from the workers, assemblers to the executives. And it's got a really diversified company base out here where without any reliance in any one industry. You know, out this way, we have not been immune to the explosion of e-commerce. We've seen a tremendous amount of growth over the last 18 months. One large e-commerce entity, which has been the biggest driver of a lot of the newer product acquisitions in our market. This large retailer had only about 150,000 square feet in 3 buildings in the entire North LA market. This was at the end of last year, the end of 2019. Since then, they've completed over 7 large transactions totaling about 2.4 million square feet. Most all of them have been last mile facilities that are in the 150 to 250,000 foot range. And many of them have the associated parking lots for the vans that go along with these requirements that deliver the stuff to your house. So with those large transactions, about 2.4 million square feet, we just completed a transaction in Oxnard. We sold a developer who works with this large entity 75 acres of land, and they are going to build the first fulfillment center that we've seen in our region. It'll be about 2.3 million square feet once it's finished next year. So in total, at the end of 2021, so the end of next year, they'll have about 4.7 million square feet of product that they didn't have in 19. So a lot of growth in that department. We're not only e-commerce out here. I'd say that it represents about 75% of the actual transactional volume that's gone down. but we have a diverse economy, as I've mentioned. We also have a challenge in that we only have one building larger than 100,000 square feet that exists in the confines of the actual San Fernando Valley. So hyper tight market, but some other industries that are really showing some growth. Entertainment. Obviously, we are somewhat of the birthplace of entertainment, with a lot of the large studios being located in the valley. They're already a large driver to our economy, and they've been ramping up from the COVID shutdown. And we're now starting to see transactions happening right now, most of them being in the San Fernando Valley and Santa Clarita Valley as an expansion location for those guys. We've also seen food and beverage gain a lot of momentum, cosmetics and beauty products. And then another large aspect of things is bio and life science. We're seeing a lot of increased activity in this growing space. One example is a company called Instill Bio out of West LA, moving into the valley and taking down a 100,000 square foot campus in Tarzana. Again, trying to accommodate, the lack of housing that's available on the other side of the hill, and a diverse set of labor available out this way. And then the other place where we see more bio life science is out in the Conejo Valley, where the companies like Artara Bio and where Amgen is located, as we're seeing a lot of startups grow in this exciting space. That's kind of what we see overall out this way, Rob.
Great. And you mentioned food and beverage, and as Josh had mentioned at the outset of this webinar, we did get a number of questions pertaining to what is happening in that food and beverage world and industrial. John M., you and your team work in the Vernon market and beyond. And Vernon, of course, as many know, is where a lot of the food companies and food-related companies call home in Los Angeles. So John, what are you seeing in that world of food type users?
Yeah, the food, so the food industry overall is very stable. Obviously, the population base here isn't going anywhere. People would be amazed at how much food is actually manufactured here in the greater Los Angeles region. It's pretty eye-opening. They're very expensive buildings, and they're very, very different. We just got a recent freezer quote for a client of ours, and it was $92 a square foot just to build out the box. Coolers are up to $70, $75 a square foot. Some customers want to be able to turn the temperature on from being on vacation somewhere across the world, and somebody else wants to, the more traditional route. So there's very little of that product available. A lot of people are predicting that with the vaccine push and the need for cold storage, that whatever vacancy is out there is going to get even smaller. But this isn't a segment of the market that, frankly, most people would recommend speccing any cold storage product in. It's very rare because in good markets and bad, when the cold storage space is so highly specialized and it's so expensive for these companies to move, that they've really got to be under the gun to pick up their bags and move to a new facility, because it's just incredibly expensive. So they tend to grow roots. So it's a very stable asset class. If you buy it, they tend to stick around for decades, literally decades and decades. We're closing in early December on a portfolio of about 300,000 square feet, and one of the buildings was built over 70 years ago, and it's fully leased. It's always remained fully leased. It has quite a bit of functional obsolescence, but it's what's out there and it's what's available, and people figure out, how to make it work. So it's a dynamic industry. It's a great provider of jobs for the Southern California marketplace, and really good jobs. It's a skilled labor force, and it's growing. But man, is it hard to find food buildings, and nobody's going to go out and spec a food building because they're so highly specialized. Every segment of that industry is very, very different. The group that processes fish doesn't necessarily work for a building that's to AIB baking standards. That's very different from a produce distribution warehouse. So it's all very highly specialized and very different.
Thanks, John, for that. And one constant I think we all have seen is the Port of LA and Long Beach. They're the constant driver to our industrial demand here in Southern California. Lisa, you oversee Prologis' 15 million square foot South Bay LAX portfolio. And within that, I know you have lots of port-related users. Could you maybe give us a little color on what's happening at the ports and how that's affecting demand?
Yeah, definitely. So The resiliency of the SoCal market, specifically, the LA submarket, is really impressive. Q3 and now into Q4, leasing velocity has picked up. Vacancy has dropped dramatically. I mean, it really never spiked too high throughout COVID, but it's down near record low again. The ports of LA, Long Beach each recorded an all-time monthly record in October for total TEU volume, which is impressive. Combined, the two ports, LA, Long Beach, saw almost 200 vessels called last month. But although the activity is at a high for both ports, total year-to-date TEU volume is actually down by almost 2% when compared to the same time period last year through October. But the year isn't over, so we still have 2 more months. And really, based on my conversations with a lot of our 3PL users, they're expecting to have peak season actually extended because there's such a pent-up demand. There was, a lull in product coming through at the start of COVID in Q2 into the start of Q3. And now all of that inventory is being released and there's a lot of demand by consumers. So I'm anticipating, if I were to bet, that we would likely see the port volume exceed year to date from last year.
Yeah, and John D. And John M., both of you, I know I've seen you work with many 3PL type operators out there. So maybe John D., maybe shed a little light on what's happening in the 3PL world, and John M., you could maybe tag along.
Yeah, we're not as driven by the port as perhaps the markets to the south of us, but we definitely have bulk distributors. It seems like a lot of the bigger operations that are quote unquote distributor types that import export are sole proprietorships, partnerships, not big corporations. We found that most distribution users that are larger, and again, we don't have a lot of large facilities in our market. So typically, once you get to around 300,000 square feet, either in multiple buildings or a couple or even one, they make their way to the Inland Empire, where bulk distribution space, is really kind of what that whole market's about. A couple examples of that are Harbor Freight. They used to be located in Camarillo, and they moved all of their bulk distribution out into the Inland Empire. And then Decker's Shoes, who makes a lot of different shoe products. They had operations in Camarillo, Oxnard, and Ventura, and moved everything east to a larger, more functional building, as it becomes almost a necessity after you get above that size, because we don't have the kind of product to make that kind of operation efficient. John?
Yeah, I'll weigh in there, Rob. I don't think most people in the greater LA region have any idea how important the ports are to the greater LA economy, period. I mean, our ports are combined, I think, 9th largest in the world. My computer froze when Lisa was speaking, so I might be repeating something she said. And I agree that the growth is, the supply chains now that the pandemic is, we're figuring out how to work with it. They were so broken from Asia to the ports from, March through August, and they're just getting unclogged now. So we're seeing an enormous amount of demand in the infill from 3PLs. And really that's driven by the drayage cost. The first tier of drayage to get a container from the port into a facility is the South Bay. Once you leave the South Bay, the second tier cost, it runs from basically Vernon all the way into Orange County. And then it goes up to a third time when you hit the San Gabriel Valley and so on and so forth. So it behooves these companies to be closer to the port because it's less cost in drayage to get these containers to the facilities back and forth. Plus the drivers can only be on the road for I think it's 11 hours. And so they can do 2 turns to the port, being within roughly a 20-mile radius versus being out in the Inland Empire, where that obviously with traffic and just sheer geography becomes significantly more difficult. The amount of activity on empty buildings right now that are 3PL driven occupancies in the last 45 to 60 days is unbelievable. Pretty much anything that's empty has great activity. Some buildings with multiple tenants chasing the same building, and a lot of it is 3PL driven right now.
It's great to hear about the real-time activity, and then of course some deals that we touched upon earlier, actual deals that happened. Let's look forward a little bit and where there are going to be areas of opportunity for development. both now and in the near future. Adam, I know you and your firm are laser focused on Southern California and looking for more value-added conversions like you've done already. Maybe talk about what you're going to be looking for and what opportunities you see.
Sure. So, there's really three types of assets we look at here in the infill. I mean, the politically correct thing is we'll buy anything that makes money, but we'll save that for another time. So what we've been doing since company inception, and we're going to continue doing on a go forward, is really three tranches. The first thing we look for is land, similar to the example we touched on early on in the conversation. We look for 2 to 10 acres within the infill markets. It's really tough to find 10 acres. But as you get smaller, this market was built 50, 60, 70 years ago from an industrial standpoint, maybe even longer. And in there are a lot of these small contractor yards that still remain. Those are perfect locations for overflow e-commerce last mile facilities. And so we target those facilities. We come in, we implement horizontal development on those properties, which is really just paving them, fencing them and lighting them, and then we go to look to lease to the last mile users, the e-commerce groups or the contractor groups, cable providers, those types of groups. Tremendous demand because most of the large land sites have been developed over the last, call it 20 to 30 years with newer products. So that's segment one. The next segment is low covered land plays. And how we look at these is any building, any structure that's less than 40% coverage on the site, we deem a low cover land play. These sites are in high demand from e-commerce all the way through a lot of the industrial users in the market. Again, these properties are somewhat challenging to find because development has taken place that has really maxed out coverage on most of the land within the basin. So what's the nuance on these sites is we need to find the excess land to be in a position that the municipalities will buy off on for allowing tenants to either park vehicles or put product outside. Oftentimes, if the excess land or the layout is up front, adjacent to the street, or just generally within public view, the municipalities will not give you permission to fill those yards with product. So that's a crucial component of those low covered land sites. Everything, the structures need to be in okay condition. We can repurpose those fairly easy. The one crucial factor on those buildings is that the loading needs to be very accessible. There needs to be decent truck turning radius in order for these properties to hunt, so to speak. But everything else, throw some dollars at it. You can put lipstick on it. You can create some new door openings, new office, and that kind of stuff. There's tremendous demand in the market for those type of properties. And then the last is the common one, which is just Class B and C existing properties throughout Southern California. And as John McMillan just mentioned, the demand right now almost feels insatiable. Obviously, the Class A product gets a lot of attention, but anything within good proximity to rooftops or within the population, the dense population areas, has a lot of activity on it right now. So what we try to do is we look for these Class B or C assets. We call it, we take less than Class A assets and turn them into B plus assets. And B plus is a huge category. But what we're really seeing is the users are hyper focused on excess land for parking on these facilities, as well as loading. Clear height has kind of waned over the last years as we bring in this last mile, specifically the last mile users just trying to get to rooftops. So those older buildings can be repurposed well. And as I touched on earlier, if we can find any of these assets in the quote unquote business friendly municipalities, those become huge targets for us, and we'll continue to do so going forward.
Great, thanks, Adam. We've gotten some questions that are coming in. So Lisa, don't get mad at me. I'm going to pivot a little bit, and I'm going to try to address some of these good questions. One which is coming in, and it's obvious, it's very logical. We're talking about e-commerce, but of course you got to get on the computer and you got to go to a server to do your order. Whether it be on Amazon or anything else, any other website online. And Lisa, I know you were involved on one of the Prologis data center buildings very recently. So through that experience of working with that customer, what can you tell us about the data center world? Do you see more conversions coming, and are there any specifics you learned from that particular deal?
Yeah, it was very interesting. I mean, not only dealing with the user here in the LA submarket, but they have locations throughout the US, and then also reaching out to our colleagues in other markets who have done, a lot of the bulk data center leasing. Again, the data centers, yeah, I do think that there's going to be growth in that. I think when I worked on the transaction recently, a lot of the focus was on infrastructure into the building, the capital that they were raising to then put into the building to improve, the amount of power that they need. So they're also then, the data centers are working with the utility companies to either source that power if it's not there, or on then some of the new builds that we're doing, in other parts of the country, that's kind of, part of the equation when negotiating like the build-to-suit leases. But I definitely think there's going to be an increase need for data centers. And you're right. Everybody's on home, working, doing school, shopping, watching movies. So yeah, it was very interesting. I do think that we're going to see a lot more of that, trend closer in these urban locations, not just in the rural.
Well, thanks, Lisa. And again, I'm sorry, it was a curveball. I threw that at you. You nailed it. So thank you.
Pleasure.
But that was a great question coming in from the audience. As I mentioned maybe earlier, everybody on this panel has been pretty much industrial their entire careers. And John, both of you and Newmark teams have been at the forefront of a lot of numerous high-profile acquisitions and dispositions. Through that, are you seeing new players come to the table? Because we're hearing, that of course industrial is the hottest commodity right now. So are we seeing a shift of traditionally office and retail oriented users coming into the market? Are you seeing those type of buyers on the table with all the offerings you've had recently?
I'll go first since I can see that John is on mute. Yeah, it's amazing. So when the lockdown first happened, I'd say the market went on pause across the board for a couple of weeks in late March, where everybody was figuring things out. From April on, the amount of groups that have wanted to do phone calls to better understand the industrial sector that are major players in the office and retail sectors has been astounding. And I was actually told by my manager at one point that I had not committed to be on a couple dozen calls that I had been requested to be on. I just can't do it. We're so busy right now. We're putting in 12-hour days as it is. Each of these calls is an hour long. I think you're going to definitely see a shift of capital. We've already seen some groups that have historically been in the office and retail sector. We're now seeing them starting to close on a few acquisitions. Not a lot, but it's going to be a growing trend. And it'll be interesting to see what sorts of yields they can, live with. But if we just see a shift of, 5 or 10% of that national capital that typically goes to office or retail get shifted into the industrial sector, it's going to be billions of dollars. So I'll be very curious to see next year and the year thereafter, if the trend continues, if we see cap rate compression.
Yeah, I'll echo what you said, John. It's been the same up this way. Obviously, landlords of office and retail are looking at a very different circumstance than what they had, in January of this year, for example. And so there has been tremendous, as you have indicated, John, interest in people looking at the industrial sector. It's very different for a lot of people and they can't do it, but we have transacted with those. We've got 2 transactions happening right now on industrial land with entities that were previously focused on office, but have made that transition quite easily because they figured it out. There'll be more of that. The other thing that we're seeing, we've engaged with, I would say, 4 clients that are asking us very detailed questions and analyses about retail to industrial conversions. Obviously, as we talked about in some of your examples, John, it has to have the right ingredients, but there are several assets out there that have the right ingredients to convert from retail to industrial, as that segment of our commercial real estate sector is struggling and probably expected to continue to struggle, and e-commerce is going to drive. So yeah, it's amazing how much more interest there is in industrial relative to the other food groups, and I guess we're just happy to be a part of it.
Yeah, and Adam, I know you and I have maybe even borderline complained about some of the players coming into the industrial market, and you've done a great job of raising capital. I know a lot of people want to invest with West Harbor. And are you seeing the same thing? Are you seeing a lot of money coming in and wanting to get into the industrial game?
Yeah, I mean, the simple answer is yes. We're seeing we're seeing that, and we're also seeing the global dollar still flow into these markets, right? Which those pressures have been here for the last 10, 15 years. They're picking up obviously with COVID and what's going on the rest of the world. So yeah, short answer is yeah. I think the last mile investments are bringing that to the forefront as well. We're seeing buyers come in and take down assets, really just dropping their return thresholds to almost nothing, just so they can put one of those assets in their portfolios. So yeah, continued cap compression for sure. We just saw a 3.5, 3.6 cap rate deal go down on 1 million square feet in the mid counties. So it's definitely upon us right now.
Yeah, thanks for that, Adam. Lisa, we all see the stats, and at Prologis, for example, all of our big boxes, seem to be full and remain full, just as the same with the whole industrial market. But not to put a negative spin on anything, you oversee a lot of different sizes and product types. And so with the stats look great because all the big boxes are full. But are there areas that are still having challenges due to COVID, certain industries, things like that? Could you maybe tell us, maybe what the issues are out there with some different types of users?
Yeah, sure. Well, at the start of COVID, obviously, Q2, we saw auto hit really hard, travel, tourism, entertainment, people, 3PLs that service conventions per se, restaurants, retailers that really didn't have an e-commerce presence. So as we emerged from Q2, we basically saw the demand for logistics real estate strengthen and diversify. In Q2, I had a handful of availability of older Class B product, but in the South Bay submarket. And in Q3, it was all absorbed. So there's definitely leasing momentum across a broader range of industries and size categories now. And that, goes anywhere from large corporate users down to the entrepreneurial small users. I mean, really, I think John M. talked about the diversification of the supply chain and how it's now rebounding. Users big and small, everyone had to reevaluate where their inventory was coming from. And so they started to diversify away from just a single source. And so now we're seeing the implication of that. A lot more product is flowing through. Users of logistics real estate have, shifted their focus. And like I said, occupancy is, back to record highs. So it's been interesting.
And earlier, John DeGrinis, you mentioned, the type of companies in the North LA market. How about how has COVID affected some of those out there in your market? Well, it's clearly affected your ability to hit the mute button.
Yeah, this whole mute thing. Gee, gosh, I apologize. We've had a lot of activity post-COVID. Obviously, March 16th hit, and a lot of us were probably wondering what was the future going to be like. I did not expect for industrial to be the resilient one that we have seen it to be, but it's been, I would say, within 6 weeks of that date, it just was all out. And we determined at that point that some of these larger e-commerce entities were not going to slow down. They were going to go pedal to the metal. And so we've been involved in a lot of land sales that involve new development. Most of the stuff that we've been putting to paper and now seeing come out of the ground has been the bigger product type. The other thing, of course, that affects our market is a lack of land. So we don't have much to really go around. So the bigger product type, totally covered. The one area we don't have as much visibility into is the business park product. And we handle a few larger multi-tenant business parks. And we haven't seen a mass problem. We've had some tenants go out, of course, and we've had some tenants struggling. But I think the visibility into that isn't as clear as I would like. There's also been, of course, an eviction moratorium, which hasn't really given a lot of clarity of how that's going to shake out. But the one thing I will say is that the users, in our anecdotal discussions with them, appear to be doing quite well during COVID. and they're extremely resilient, doing whatever they have to do to make money. So we've been quite surprised in the fact that so few entities appear to be having problems, but that might not be as visible as maybe what we'll see going forward. We're still very optimistic though.
Great, thanks, John. Well, a number of questions continue to come in. I'm sorry, did you want to add to that, John McMillan?
Yeah, I was just going to add that I don't think a lot of people realize that Los Angeles County is a 1 billion square foot industrial market. And people still make a lot of stuff here. Still have, thank God, a lot of manufacturing. We've talked a lot about e-commerce, but we have an amazing garment industry. Obviously, we talked about the food industry. There are people who still make furniture here, who make all sorts of product type. And I'm just blown away, frankly, at the variety of tenants in the market out there and that are bouncing around from, all the way down to 10,000 square feet. We were very concerned about some of our smaller product at the beginning of the year because it wasn't moving as quickly as past years. In one park in particular, we had a unit come out, and 2 years ago, we had 7 offers in 1 week for a 10,000 square foot unit in the park. Then we had 3 units in that park in the first quarter of this year, and it was just dead quiet. Now we've got multiple tenants moving around, and we're just seeing that across the board, which is great because a lot of the job growth, frankly, comes from smaller and mid-tier companies that are growing. They're, run by entrepreneurs, and, the whole entire world can't be Amazon. Amazon has 200 million square feet nationwide now. It's unbelievable. They have almost 40% of e-commerce sales. But, they are still a smaller segment. I shouldn't say small, they're still huge, but they are not as big of an occupier in LA's 1 billion square feet as a lot of people might think. I mean, it's an incredibly diversified industrial base here.
Yeah, John, I want to add to that. I'm glad you brought that up because we talk so much about e-commerce and all the things that we purchase that end up on our porch. But one of the things that is really critical to remember that Los Angeles was one of the largest, I think it was the largest manufacturing base in the country for the longest time. And that is our roots. And, the San Fernando Valley takes that to another level. I mentioned the history in terms of our history with aviation and aerospace. But, one of the things that we talked about earlier was food. And food has come into the San Fernando Valley and Ventura County in a big way. Monster Energy took down the most expensive site that we've seen. They paid over $100 a land foot for a 165,000 foot a site that was entitled for a 165. Then we saw Chick-fil-A right around that time come to our project up at IEC in Valencia and buy the 200,000 footer there for their lemon processing. And then just recently, a couple of weeks ago, we just inked a transaction with a company called Drink Pack for 175,000 square feet for a beverage manufacturing facility. And what was interesting about that is they started their search in Ventura County. We couldn't find anything out there. We kept moving further east. There was nothing in the valley. We ended up in Santa Clarita because that was the only place where we had buildings. So we're seeing tremendous and robust growth in a lot of different categories that are called manufacturing. It's not all e-commerce. I want to make sure that that's reiterated. Thanks.
No, we got it loud and clear. And a lot of questions were coming in, about the Inland Empire. Now, the 5 of us here are all infill LA people. So, we're proud of what's happening in our 1 billion square foot. Granted, they are up to like 500 million feet out there, but we all have teammates and partners out there in the Inland Empire, and we know all the big boxes are going out there. But we've seen this trend before, and it obviously is continuing now. Lisa, John, anyone can take this, but do we see the old cliche of rising tide raises all ships? Is that applying? Is that helping us, the Inland Empire rapid growth? Is that helping the infill markets? Bueller?
Yeah, I'll jump in because we're in the middle of 2 deals out there right now. It's absolutely on fire. And I think it's up to 630 million square feet. I mean, there's still land out there, right? In the infill, John just brought up a site that sold for over $100 a square foot. I mean, it gets tough to start to make development pencil at those sorts of numbers. And in the Inland Empire, you can still buy land. It's incredibly competitive. And if you're distributing to the greater Western United States, or even the entire United States, you can do that from the Inland Empire. That gets a lot tougher to do in the infill markets. Plus they demand, that's a higher Fortune 500 type of tenant base for the most part. And they require a lot of trailer storage because out there you are getting the product coming and going on full-size trailers, and you need to be able to park a lot of trailers on your site. But we just heard of a rent in Fontana at 75 cents triple net in a brand new building in Fontana. That would have been a rent that you would have seen anywhere in the infill 2 years ago, 3 years ago. I mean, that's an incredibly high rental rate. So as it gets tougher out there to find, cost-effective space, yeah, that's going to buoy the infill, and the infill rents are still, rising. And frankly, I'm of the mindset that next year, we're at a 2% overall vacancy rate for LA County, and that includes two very, very big over 1 million square foot facilities that are going to get converted to something else. They're not going to be what they are today. You pull those out of the vacancy, we're at 1.5 points. And that includes multi-story buildings, truck terminals, freezer warehouses. So when you start looking for, clean, dry, functional, dock high industrial space, it gets very skinny very, very fast. So you've got to go to the Inland Empire, especially if you're over 300,000 square feet, because we just don't have a lot of big boxes in the infill market. So yeah, I'm of the mindset that whatever is happening out there is good for LA, and whatever's happening in LA is good for the Inland Empire. It's just, they're tied to the hip.
I think you're also going to see additional growth out in the Inland Empire because of pricing. I'll just use my market as an example. There are several land transactions that have gone down and those that are going down. I'll use one example. One's going to close next week, about 28 acres. The land value will be in the mid 80s per land foot. So if you do your analyses, you can't build a bunch of small buildings, so you'll price yourself out of the market. You got to build one big distribution building, and the rents that it'll take to work an $85+ land number is about $1.20 to $1.30 triple net. And then the expenses on that will be pretty hefty too, given the tax base. So that's going to not allow for everybody to occupy that kind of building. And I think it's going to push some of the larger users who would move into a 500,000 square foot building in the valley at $1.20. They're just going to push them further east where there's opportunity to get that building at a much more of a discount. So I think it's going to be continued growth out east as other users are pushed from valley markets to places out like the Inland Empire.
That's great insight from both of you, as we know you're working with a lot of customers contemplating that migration. This has been great. I mean, the hours frankly flown by. I was stressed last night how we would fill it. But I'll wrap it up with the last question, maybe just a brief answer from each of our panelists. But how do you see California over the next 5 to 10 years? Obviously what you've heard today is exciting and positive, but at the same time, and we don't want to turn this into a political forum, but there are challenges in California, cost of living and different initiatives being contemplated in Sacramento. But give us a quick snapshot of how you see it 5 to 10 years as we wrap it up. I'll start with you, Adam.
Yeah, I mean, I think you touched on it. There is talk of this out migration. I don't think yet it's as big of a deal as it's blown up to be. Sacramento has their issues, and hopefully they figure it out from a business standpoint. But here in Southern Cal, I mean, we have 23 million people that have gotten very accustomed to same day and next day delivery, right? And that's not going to go anywhere. Lisa touched on it as well, as I think some of the other panelists, the ports, right? Though, barring something out of left field, those aren't going anywhere, right? And they're the most critical supply chain link for imported goods coming into this country. So, that there's very little land. I mean, we're all in. Fundamentally, I think Southern California is going to remain strong for 5 to 10 and beyond. We just recently partnered with a state pension fund and closed a private equity fund to the tune of about $200 million just to buy here in Southern California over the next 5 years. So we're big believers, and fundamentals will continue driving all the demand in industrial.
How about you, Lisa?
Yeah, I mean, similar to Adam, I mean, I do think that e-com is going to, it's here to stay. It's going to be accelerated. I also think that more higher levels of inventory on hand is also going to become a trend. I don't know if it's going to last forever, but in the immediate future. So I think that the combination of those two trends are going to increase demand for logistics real estate, specifically in the SoCal market, because I mean, it's a huge market in and of itself in terms of the consumer base, but it's also a critical step in the global supply chain, you know, with the ports of LA Long Beach. So I think those factors are, you know, pointing in the right direction for us.
And how about you, Newmark Johns?
I'll go ahead. So, I mean, we have all the reasons to be positive about what California is. Has the best climate in the world, as many have told me. We've got a very functioning economy. It used to be the Golden State for a lot of reasons and probably still is, but we can't ignore some of the challenges that we have. You know, housing costs is a huge one. That's something that's going to take a lot of brains to figure out. You know, we've got a heavy duty homelessness problem that needs to have attention, you know, and some of the other urban issues that are going there. But I think that we can figure out some solutions towards those. I don't know how much effort really has gone towards actually trying to alleviate that, but we've got a lot of reasons to see California blossom again. And we certainly hope that Sacramento is recognizing some of the challenges that are there and addressing them. There's a lot of reasons to believe that this will continue for a long time going forward.
Weather, ports, people. Those three are the key features for Southern California industrial. Manufacturers are having a harder time with you know, red tape. If there's anything that I would hope we see happen, it's that, you know, people realize that if they want their stuff within an hour, it has to come on a truck. There is no other way. It's not getting teleported. So we have to figure out how to work with the industrial sector, and we need the local municipalities. I think there are 88 of them throughout LA County. I don't know how many exactly have an industrial footprint. Let's say it's 40 or 45. We need people, city council members and residents, to understand that we need better redevelopment. We need to provide these facilities. Otherwise, we can't handle the growth. I mean, we moved a food processing company to Texas a couple of years ago because we just couldn't find an asset here. There were lots of reasons, but you know, it's so hard to get sites entitled for industrial because it's last on the list for what any city wants. Every city wants retail. It creates sales tax revenue. That is just not the model of the future. You know, I mean, and e-commerce is the growth of e-commerce. I've seen different stats on it. It's only 20 or 22% or so of total retail sales right now. It skyrocketed 30 to 40% in the last 6 months alone. My 84-year-old father-in-law figured out how to buy his wife birthday presents online through the pandemic because he couldn't go shopping anymore. There are millions of people out there like that who amazingly are still discovering e-commerce. And so that's not going to go anywhere. So we need to figure out how to accommodate the industrial growth because there's going to be a lot of jobs that come from the industrial sector. And we need a better understanding of how to work with the industrial developers to repurpose these properties and make them functional.
Yeah, well, we appreciate all of the insight today. And thanks to the four of you for taking time out of your busy schedules to join us. And some great takeaways today. Josh, I think I'm going to hand it back to you. And again, we appreciate the LA Business Journal creating this forum for us. So thank you.
Well, thank you. And I want to kind of give sort of the best background award to Adam. Not only is it a background, but it's a real background. It's not even like a fake one. With the surfboards, I actually thought it was really cool. And it's such a great reminder for all of us of why we love doing business in Los Angeles. So I thought that was fantastic. You know, I always say a good panel should leave you all feeling smarter when you leave than when you got there. Based on that criteria, we had an amazing panel and you guys all over-delivered on that. Thank you guys so much for all of the information, for your preparation, your market insight. Thank you, Rob. Just an outstanding job moderating, letting us throw some audience questions in there as well. John, Adam, John, and Lisa. I want to thank Newmark and Prologis once again for sponsoring today's discussion. As I mentioned early on, for those of you interested in the Prologis Part 1 of the Automation Series report, if you send us an email at events@labusinessjournal.com, events at labusinessjournal.com. We'll be happy to send out the link to you. Additionally, for those who would like to pass this on to others who perhaps weren't able to view it today, there will be a recorded version of this entire program available on our site, probably as early as tomorrow, and that's labusinessjournal.com. So thank you to all of our panelists. You guys were fantastic. Thank you to Rob. Thank you to our sponsors. And we'll look forward to hosting you in our next real estate strategy series soon. Thanks. Have a good day.